All right, here we go. Hey there, we're live. It's Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's a show about taking control of your money, about your personal finance, borrowing, spending, investing. We talk about it all here while you're watching. If you have any questions, certainly hit me up in the comments. I love hearing from you. It's the best part of doing this, hearing your questions. If you have any words of wisdom, you just want to say hi, words of encouragement, put those in the comments too. It's always a pleasure to see that. And while you're watching, also, if you don't mind, give us a thumbs up, a heart, an applause, a wow, whatever the reaction is available to you, depending on which social media platform you're watching on. That helps me spread the good word about the show and all the advice that I'm turning out. And we do turn out an awful lot of advice, and we answer an awful lot of investor questions and personal finance questions, which means there's always something here for you, something for you to help out, and always a way for you to help everybody else out. So don't be shy. Hit me up in the comments. I love hearing from you. Two unlikely stocks that really show that we are in an up market, a roaring market. We talked about recession. I said by the time we get to a recession call, two negative quarters of GDP, in this case, it's not the only definition of a recession, but it's a popular one. By the time we get to that, stocks will start going up. It's exactly what happened, right on cue. I said for the last few weeks, I am very bulled up. I am still bulled up. And now you have fund managers, mutual fund managers, hedge fund managers, people who are really performance sensitive. They are so behind their benchmarks because they went to so much cash and loaded up on consumer staples, companies that sell things you need like toothpaste and toilet paper and food. They've loaded up on those, and they've raised a lot of cash, and they got out of a lot of tech. All of a sudden, the market's going up, leaving these fund managers' performance in the dust. And now these fund managers have to scramble and catch up and start putting money to work. And that is enormous fuel for the stock market. Are we in a recession or are we not? We could debate this forever. But there there is a there's a sense that we've skirted one, that we went by it. Regardless of what you and I think, and you and I could agree or disagree, we have to go by what the Federal Reserve thinks, because that is the body that's in charge of controlling short-term interest rates. And the Federal Reserve, from Chairman Jerome Powell down to all the other Fed governors, are consistently saying and sticking to the message: no recession, no way, no how, ain't gonna happen. And that is the kind of soothing message that investors needed to hear, which sent stocks up today, made up for yesterday's losses handily, and we continue the move up that began in earnest in June, carried the July S&P 500 up over 9%, and continuing now in August. You can't invest directly into an index, but you can invest in a security that tracks or mimics an index. I know that sounds silly, but there is a difference. So let's roll the intro. I see a few people out there. Hunter, thank you so much. Jerry, man, thank you very much. Really appreciate you being here. And here he is. Hey, good market today. Damn right, Jerry. Thank you very, very much. It's such a nice picture of you and Lori, by the way. All right, so let's roll the intro. And we're going to get into the day's action and talk about a couple of personal finance things and market things. I always just like throw in my personal anecdotes, life's lessons, and perspectives in these shows. And I just, I do these like I'm talking to you, just two people talking, and that's how we're going to do it. So here goes the intro. Stick around. This is going to be good. All right, we're back. We're just getting started. We haven't even talked about the stock market yet. Couple of things to talk about, but let's talk about a key signature of bull and bear markets, because it looks like we're in a bull market now, and a pretty solid one. We could be in a rebound from in a bear market. Sure, this could be just a big rebound and it's all for nothing, and stocks are going to go so much lower that we're going to wish we never even heard of the stock market and just be in pain and lose so much money that we panic and sell everything and basically have to start all over. And yeah, that would be terrible. That is like the nightmare situation, right? The nightmare scenario, but that's not what's happening. Okay. What's happening is this. Just hear me out. In a bull market, stocks go up for any reason. Literally, like even companies that have bad news go up. And that's a sign of I hope I'm coming out nice and clear to you guys. That's a sign of a bull market. Your company missed earnings, missed revenue, whatever. The stock's up 4% in pre-market trading. After market trading, the company misses on subs, they miss on users, they miss on this, they miss on that. Yeah, but we'll try again next quarter. Stocks up 10% after market trade. Just like in a bull market, stocks find a reason to go up. A bear market, stocks find a reason to go down. Company beats earnings, beats in revenues, beats in the top and the bottom line. They beat this, beat that. Stock is down 6% in aftermarket trading. It's just down. Why? Because we're in a bear market. And you could take the same news of the same stock. And if we're in a bull market, that news will send the stock up. Bear market, that news will send the stock down. And when you start to see, how do I say this? When you start to see companies come out with bad news or news that misses expectations or things are worse than we thought and the stocks still go up on bad news, that's a telltale sign that we're in a bull market, that there is a lot of strength behind stock moves, a lot more to go, very bullish. Okay. And if we take a look at two stocks, for example, and I'm going to say two of the lowest quality stocks you could find. One is Robinhood. All right. Losing a lot of money. And, I don't know. It's up a dollar. See that? All right. Up a dollar, up almost 12% today, after yesterday announcing that they're laying off a big chunk, like 23% of their labor force. All right. What's the other one? Under Armour. Under Armour reports a miss. Stock was still up, though. Stock was up 2.5% today. It was up even more at one point today, but it was still up today in spite of bad news. And I'm starting to see this happen with fintech stocks, with other areas of the market where, the news hasn't been that great from a corporate standpoint, where it's just been downright lousy. And stocks are still, they're still finding a way to go up. It's a sign that the selling is exhausted itself. The sellers are done selling, and you now have buyers left. And as the market goes up, as fund managers see the market go up without them, the fund managers, like we spoke about at the top of the show, they have to start buying and putting money to work. Performance anxiety. Market might be flat for the year very soon. Market might be up for the year very soon. And if you locked in your losses and your portfolio was down 10%, but you were looking like a genius when the market was down 20%, well, now you're still down 10%, but the market's flat. That's no good. So now you have to buy with both hands and start throwing money in. This is why I said yesterday, I thought yesterday was an aberration when the market was down. We were in a rip-roaring bull market for the right reasons. Companies have been able to raise prices on consumers. Consumers have been paying. And even though there are a lot of people suffering, and even though I've said before, I do believe we are in a overall recession, not to say every part of the economy is in bad shape, but overall a recession, doesn't matter, okay? The company's account are going up. Now, I want to tell you something, that a recession, talking about a recession, talking about a recession today is we have a comment here. Just want to see. I hope you don't have performance anxiety. Funny. Yeah. That was funny. I will let you my eye. Okay, yeah, okay. Yeah, so that was pretty funny, Jerry. Only you, man. Thank you. So, what the F was I talking about? What? I'm talking about the stock market. Okay. Stocks go up on bad news. It's a bullish market. Stocks go down on good news. It's a bear market. That's where that's where we are right now. I think stocks go up for almost any reason. Money's coming into them. So let's take a look at a couple of things. SPAC. You see this? The SPAC market, special purpose acquisition company. SPAC market hits a wall as issuance dries up and valuation bubble bursts. We talked about SPACs. We used to talk about SPACs, these stocks that go public via a SPAC. We used to talk about them so often that they would always, we talked about them so often. And my point was, these are really like very speculative, aggressive ways to invest. So speculative that I think people are going to get hurt. There comes a point when you take more risk over time, you could potentially earn more return, earn a higher return. But there also comes a time when you take too much risk that you are almost guaranteed to make a mistake and lose a whole bunch of money. That's how we talked about SPACs. So when the SPAC, SPAK, came out, when the ETF that covers SPACs came out, this was at one time about $35 a share, and now it's 14. So for all of you who thought, oh, I'm buying a diversified portfolio of SPACs, it's diversified. Doesn't mean squat. Okay. Birds of a feather flock together. SPACs are SPACs. When they go down, a few go down, they probably all went down. And that's exactly what happened. Even Bill Ackman's big SPAC, he wound up giving the money back to investors. So if you know how SPACs work, they raise money. A SPAC has 2 years to make some kind of acquisition of a publicly traded company so that the SPAC could become the new company. If they don't do it in 2 years, they have to give the money back to investors, and SPAC managers are pressured to make deals when they might not necessarily be in the best interest of the SPAC shareholders. But the SPAC managers, they don't want to give the money back because they give up on collecting fees. Bill Ackman did the right thing and said, I'm giving the money back. I wish more people were like Bill Ackman. So anyway, there we go. So this was about 35. It's 14. And it really was just a sign of the times of the speculative froth from 2020 to early 2021 when the speculative bubble burst, including meme stocks, SPACs, and pandemic stocks. So let's go to the big board. Let's go to the big board. All right. So the Dow is up 416 points, handily made up for yesterday's down day. Nasdaq up 319. That's only a 2.6% update today. That is pretty huge. S&P up 1.5%. Gold off a drop. Oil continues to go down. Oil is going down a slippery slope. I mean, investors are just getting their profits burned up in oil. I'm trying to come up with a few puns, but maybe they're not so funny. The 10-year yield at 2.7, the VIX at 20. Oh, this is so good. 21.95 on the VIX. I'm telling you, we see that get to below 20. There's no doubt the rally is sustained and goes up more. So that is where we are. Let's take a look at the bond market. Yields are a little bit lower across the board, which means, bonds were up a little bit. So investors maybe want to hold onto bonds. Maybe they see value in bonds, and maybe they have a little bit of fear that the economy could be slowing down, even if we don't go into a recession. It is slowing down, but that's besides the point. But 10-year yield 2.7, the 2-year 3.071. When this is 3.07, and this is 2.76, see that? When this one is higher than this one, that's what we call an inverted yield curve, and it's a pretty negative omen for the market. Jerry says Hey, Susan. I know there's like a funny wisecrack in there, and you and I are going to be laughing about this when I call you later. But I have no idea what you're talking about. Hey, Susan, but I'm sure there's something very very funny to that comment. Just to let you know, this is like a PG-13 show, more so than like an R show. I mean, I could say the word shit, but I can't say the F word or other various four-letter words. Okay. Um, so there you go. All right. So those are the things I want to talk about. It looks like this is a pretty quick show because that covers pretty much everything I wanted to talk about. Now, don't forget, if you have any questions and you think about them after the show here, or if you're watching in the replay, hit me up in the comments and I'll see them. We don't have too much else to add to it regarding today's action. We talked about personal finance a lot the last couple of days, and I think we are good to go. So I'm going to wrap it up, and I will be back tomorrow. I do see someone else out here. I see Wendy. Hey, Wendy's out there. Wendy, what's doing? So nice of you to join us. Thank you very much. All right, that's about it. I'm going to get going, and I'll see you guys tomorrow. Jerry says, Susan was watching Hinge, I think you mean, and watching. All right, I'm calling you in a couple of minutes. All right, I'll speak to you later. All right, I'll speak to all of you later. Okay, thanks. Goodbye.